question from Gary. What level of debt is acceptable and what level of safety margin is acceptable?
Okay. This is where you have to develop. It's a great question because there's going to be a different answer to every Skaffold user that we speak to and every fund manager that you would ask that question of. For me, we like to buy things at a 10% or better discount to their intrinsic value. Okay, that's our preference. Doesn't mean we always abide by that. And some of these new floats, we've invested in shares that are trading at less than 10% discount to our intrinsic value. Why? Because we believe that in 2 years' time, the intrinsic value will be a lot higher. So that's okay. So the first thing for us is 10% or greater. That's our preference. And the other part of the question was how much debt. And in terms of debt, less is always more. Now, I know that's not a satisfactory answer. You want to know a precise number. There isn't a precise number. It depends on whether or not the company, for example, generates cash from its working capital. So Woolworths, you pay Woolworths with your credit card or your debit card, they get paid overnight. But they don't pay their suppliers for 180 days, or 120 days. They won't pay their suppliers for a very long time. So the money that you give them earns interest. Their working capital is generating cash. So they could have more debt and still fund it safely than a company that doesn't have positive working capital or its working capital doesn't generate cash. So it depends on the company. So we own Woolworths, to give you an example, and it has a reasonable amount of debt. But our preference, particularly for smaller businesses, is no debt. Or the ability. But here's the thing. If they're paying off the debt quickly, so if you see that they've still got let's say a 30% debt to equity ratio, that's okay if last year it was 60% and the year before that it was 100%. That means they're generating a lot of cash. Go to the cash flow screen on Skaffold and have a look if they're generating a lot of cash. They must have a funding surplus because they're able to pay down that debt really quickly. And that's okay too. Have a look at the trend in the debt and the borrowings.